What if I told you that rushing to pay off all your loans after 60 could be one of the most dangerous financial mistakes you'll ever make? I know that sounds completely backwards, maybe even reckless. After all, isn't being debt-free supposed to be the ultimate goal, especially when you're heading into retirement? Stay with me until the end of this video, because what you're about to discover might completely shatter everything you thought you knew about debt, financial security, and protecting your wealth in your golden years. Think about it for a moment. From the time you were young, there's been this constant drumbeat in your ears. Debt is the enemy. Your parents probably repeated it like a mantra. Financial advisors have built entire careers around it. The message has been drilled into your head so many times that it feels like an undeniable truth, almost like a law of nature. Pay off everything. Enter retirement owing nothing. Walk into your 60s and 70s with zero balances across the board. It sounds responsible, doesn't it? It sounds like the smart, prudent thing that any intelligent person would do. But here's where things get interesting, and this is where conventional wisdom starts to crack. Has this ever happened to you? You're sitting there at your kitchen table, maybe on a Sunday afternoon, with your bank statement spread out on one side and your loan bills on the other. You're doing the mental math, feeling this tightness in your chest. You know you have enough money sitting in your savings account to wipe out those balances completely. Part of you desperately wants to just write those checks and be done with it. To finally experience that feeling of being completely debt-free that everyone says you're supposed to crave. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Here's what nobody's telling you, and this is the moment where everything changes. That pressure you're feeling, that guilt weighing on you about your loan balances, that voice in your head saying you're being irresponsible if you don't pay everything off immediately. What if all of that is based on outdated financial advice that doesn't just fail to protect you, but actually puts your retirement security at serious risk? What if the very strategy that worked perfectly for your parents' generation in the 1970s and 80s is quietly sabotaging your financial future right now? The truth is, after 60, the entire financial game changes in ways most people never understand until it's too late. The rules that made perfect sense when you were 30 or 40 become genuinely harmful when you're 65. And yet, despite this fundamental shift, most people walk into retirement following the exact same playbook, making decisions that feel responsible but actually leave them vulnerable right when they need security most. What you're about to discover is why smart retirees are choosing a completely different strategy. The uncomfortable reality that most financial advisors won't openly admit is that the advice you've been following might not just be outdated, it could be actively working against you. Think about where that advice came from. Your parents retired in a different world. Interest rates were sky high, sometimes reaching 15 or 18%. Inflation was different, life expectancy was different. The entire economic landscape bore almost no resemblance to what you're facing today. Yet somehow the financial playbook hasn't evolved at all. We're still being told to follow strategies designed for an economy that disappeared decades ago. Here's the transformation in thinking that needs to happen. When you were 30 years old and made a financial mistake, what happened? Maybe you invested in something that didn't pan out, or an emergency forced you to drain your savings. It wasn't pleasant, but you recovered. You had this incredible asset called time. You could work a few extra years, rebuild those accounts, let your investments grow over the next 2 or 3 decades. Time was your safety net, your insurance policy against bad decisions. That safety net no longer exists. After 60, the recovery window isn't just closing, it's already shut. When you make a significant Financial decision at 65 that goes wrong. You don't have 30 years to fix it. You might have 10 good years, maybe 15 if you're fortunate. Every single dollar you choose to allocate right now carries enormous weight because the impact ripples through the rest of your life in ways that simply weren't true when you were younger. Now, I want to go even deeper into this because there's something fascinating happening behind the scenes that reveals the hidden truth about how genuinely wealthy retirees think. The people who have real financial security, not just the ones who look rich on the surface, they play a completely different game with their debt. They never rush to eliminate low-interest obligations. Never. They understand something fundamental that most people completely miss. They understand opportunity cost. If this resonated with you, subscribe to the channel. I create content that challenges conventional retirement advice with strategies that actually make sense in today's reality. This is where the journey toward real financial wisdom after 60 begins. Every dollar has alternative uses. That money sitting in your account right now could be working for you in multiple ways. It could be earning returns. It could be available as your emergency cushion. It could be positioned to take advantage of opportunities that arise. But the moment you take that money and convert it into a zero balance on a loan statement, you've made an irreversible choice. You've sacrificed all those possibilities for what? For the psychological comfort of owing less, even though your guaranteed monthly income, your social security, your pension, was already covering those payments effortlessly. The journey toward genuine financial wisdom after 60 begins with recognizing that flexibility and liquidity matter more than symbolic victories. Being debt-free but cash-poor isn't the freedom you think it is. It's actually a dangerous form of financial fragility, wearing the mask of responsibility. The truly secure retirees understand that maintaining strategic obligations while preserving accessible cash reserves gives them power. Power to respond to whatever life throws their way, without panic, without desperation, without having to make terrible decisions under pressure. Write in the comments, flexibility matters, if this perspective is starting to shift how you're thinking about your retirement finances. What makes this situation even more critical is understanding just how dramatically the financial landscape has shifted beneath our feet. Your grandmother might have retired at 65 and lived another 10 years. You're looking at potentially another 30 years of life after retirement. That's not just a slight adjustment to the plan. That's a fundamental transformation in how you need to think about money, risk, and what security actually means. The strategies that worked when retirement meant a decade are catastrophically inadequate when you're planning for 3 decades. The interest rate environment your parents navigated looked nothing like what we're experiencing today. They might have faced 12 or 15% rates on their debts while inflation ran lower. In that world, aggressively paying off everything made perfect mathematical sense. But we're not in that world anymore. Today, you can find promotional rates, balance transfers, and loan products at 3, 4, maybe 5%, while inflation runs higher than that. The entire equation has flipped, yet the advice remains frozen in time, unchanged, as if the economic reality of 1985 still applies. Here's where the hidden truth starts to reveal itself in ways that genuinely matter to your day-to-day life. Imagine for a moment that you take all your accessible savings, let's say it's $40,000 or $50,000, and you write those checks to completely eliminate your loan balances. For maybe 2 or 3 months, you feel this incredible rush of relief. You did the responsible thing everyone told you to do. You sleep a bit better knowing those balances are gone, but then life does what life always does. Your spouse needs an unexpected medical procedure that Medicare doesn't fully cover, or your roof starts leaking and needs immediate replacement, or your daughter calls in tears because she's facing a genuine crisis and desperately needs your help. These aren't hypothetical situations. These are real scenarios happening to real people every single week. And in that moment, that feeling of relief you had from paying off your loans transforms instantly into something much darker. Panic, because all your cash is gone. You eliminated your debt, but you also eliminated your ability to respond to the inevitable emergencies that retirement brings. This is the revelation that changes everything about how you should think about debt after 60. The decision you made to drain those accounts isn't something you can reverse. You can't call the bank 3 months later and say you need that money back. It's been converted into zero balances on statements, which feel wonderful psychologically, but do absolutely nothing for you when you're staring at a $15,000 hospital bill or a $20,000 home repair that can't wait. The money is gone, locked away in the past, transformed into something that looked like responsibility, but actually left you exposed and vulnerable. What wealthy retirees understand, and this is the mindset shift that separates those who thrive from those who struggle, is that liquidity isn't just some nice-to-have feature. It's survival. It's the difference between weathering a storm and getting capsized by it. They would never voluntarily give up their financial flexibility just to see zeros on a statement, because they know that real security comes from having options, not from achieving symbolic victories that don't actually protect you when crisis strikes. Put down liquidity as power if you're beginning to see why having accessible cash might matter more than being debt-free. The impact of this realization extends far beyond simple mathematics. It affects your autonomy, your dignity, your capacity to live on your own terms, rather than being at the mercy of circumstances you can no longer control. When you have accessible cash sitting in your accounts, you maintain your independence. You can make decisions based on what you want to do, not what you're forced to do because you've backed yourself into a corner financially. You can help the people you love without having to ask permission from anyone, or explain yourself to a loan officer who sees you as a high-risk retiree with limited income. Behind the scenes of what looks like prudent financial management is often a dangerous illusion. You appear responsible on paper because you eliminated debt, but you've actually made yourself incredibly vulnerable to the kinds of shocks that routinely hit retirees. Think about what happens in the real world when you no longer have that. A cash cushion, a serious illness strikes, and you need treatments or medications that aren't fully covered. Your home needs urgent repairs that can't be postponed. A family member faces a devastating situation where your financial help could make all the difference. Every single one of these scenarios requires liquid cash, money you can access quickly without jumping through hoops or selling assets at the worst possible time. Here's where the contradiction in conventional financial advice becomes almost absurd. Every financial advisor on the planet will tell you to maintain an emergency fund, 3 to 6 months of expenses sitting in easily accessible savings. Everyone agrees this is fundamental, non-negotiable wisdom. Yet many of those exact same advisors will turn around and encourage you to drain that emergency fund, plus all your other accessible savings, to achieve this symbolic debt-free status. The journey toward real financial wisdom involves recognizing these contradictions and questioning whether the advice you're receiving actually makes sense for your specific situation. If maintaining liquidity matters, and everyone agrees it does, then why would you voluntarily destroy your liquidity for the sake of zero balances? The answer usually comes down to emotion and cultural programming rather than sound analysis. We've been taught to feel shame about debt, taught to view debt elimination as some kind of moral imperative. But those feelings might be leading you toward decisions that make you objectively less secure, less prepared, less capable of handling what retirement actually throws at you. The transformation in understanding happens when you separate the emotional response from the mathematical reality. Your monthly loan payments aren't going away just because you ignore them, but if you have guaranteed income from Social Security or a pension coming in every single month like clockwork, those payments are manageable. They're predictable. They're covered. What's not manageable is having zero cash reserves when an emergency strikes. What's not predictable is which crisis will hit first or how much it will cost. What's not covered is the desperate scramble to find money when you've already given it all away, chasing a feeling that evaporated the moment real life intervened. The revelation gets even more striking when you consider your ability to access credit after retirement. Banks and lenders look at retirees very differently than they look at working people. If you drain your accounts today and then need to borrow money 2 years from now because of an emergency, you might not qualify. Your income is fixed, your earning potential is gone, and lenders see you as high risk. That door to credit you had wide open before retirement slowly closes, whether you realize it or not. Write in the comments, "I see the risk now," if you're understanding why preserving cash might be more important than eliminating debt. Now, let me show you something that completely shifts the perspective on this entire conversation. There's an economic force happening right now that most people are fighting against when they should be harnessing it to work in their favor. We're living through a period where inflation, if you understand how it actually functions, can become your secret ally rather than your enemy. When inflation is running at 4, 5, or 6% annually, and you're carrying debt at lower interest rates, something remarkable happens that works silently in your favor every single day. The real cost of your obligations is actually shrinking. If you found value in this conversation, hit that like button. It tells me we're connecting on something important here. Think about the journey your money takes through time. If you're managing loan debt at promotional rates or balance transfer offers of 0 to 3%, and inflation is running higher than that, the purchasing power equation is working for you. Automatically, those dollars sitting in your bank account today will be worth less next year because of inflation. But here's what people miss. Your debt is also worth less next year. You're paying back obligations with currency that has less purchasing power than when you originally borrowed. The debt you took on last year or 5 years ago, those were more valuable dollars. The dollars you're using to make payments today are cheaper dollars, inflated dollars, and that difference is working in your favor while you sleep. Behind the scenes of what looks like smart financial planning, you might actually be volunteering to fight against a current that was carrying you downstream anyway. When you take a large chunk of your savings and aggressively throw it at paying off loans in this inflationary environment, you're volunteering to lose purchasing power. You're taking valuable dollars that you have right now with their current purchasing power, and you're converting them into the elimination of debt that inflation was already eroding for you. It's like working harder to achieve something that time and economic forces were accomplishing on your behalf without any effort from you whatsoever. The transformation in thinking happens when you start recognizing inflation as a force that can work to your advantage if you position yourself correctly. The wealthy understand this instinctively. They're comfortable carrying strategic debt in inflationary periods because they know the mathematics are working for them. They're not emotionally attached to zero balances. They're focused on preserving and growing their purchasing power over time. And sometimes that means keeping manageable debt while your assets appreciate. And inflation does the heavy lifting of making that debt cheaper in real terms. Here's where this gets genuinely fascinating. Let's say you have $10,000 sitting in your savings right now, and you're carrying some loan balances at 4% annual interest. Conventional advice screams at you to throw that money at those loans immediately. But what if you kept that $10,000 invested instead? What if you put it in a high-yield savings account earning 5%, or in stable, dividend-paying investments that historically return 7 or 8% annually? You're creating what sophisticated investors call a positive spread. You're paying 4% on one side and earning 7 or 8 on the other. That 3 or 4% difference represents real wealth accumulation happening year after year, compounding over time, building resources that enhance your security rather than locking capital away into eliminated debt that's gone forever. Comment below, math over emotion, if you're seeing how the actual numbers tell a completely different story than conventional wisdom suggests. The journey toward this kind of strategic thinking requires you to separate mathematics from emotion, and that's harder than it sounds, because we've been conditioned to feel a certain way about debt our entire lives. But let's think about what's actually happening in practical terms. If you're receiving Social Security checks every month, if you have a pension depositing money into your account like clockwork, if you've got annuities or other reliable income streams, then you already have something incredibly valuable. Guaranteed coverage for reasonable monthly obligations. Those payments arrive whether you have loan balances or not. They're not going to stop. They're not dependent on market performance. They're there month after month, year after year. So here's the question that should fundamentally reshape how you're thinking about this decision. Why would you voluntarily drain your liquid savings, your emergency fund, your opportunity capital, your entire financial flexibility to eliminate debt that your guaranteed monthly income can easily service? It doesn't make mathematical sense when you really examine it. You're taking accessible money that could be working for you in multiple ways and converting it into something that feels good emotionally, but actually weakens your position strategically. This is where the hidden truth becomes impossible to ignore. Being debt-free but cash-poor isn't the freedom you think it is. It's actually a dangerous form of financial fragility masquerading as responsibility. Real power after 60 doesn't come from having zero balances on statements that nobody sees except you. Real power comes from having accessible resources combined with the strategic management of obligations that cost you very little in real terms. It's about maintaining control, preserving options, keeping yourself in a position where you can respond to whatever comes your way without desperation. Think about what happens behind the scenes when you make that irreversible decision to drain your accounts. You're essentially betting that nothing unexpected will happen in your life. From this point forward, you're gambling that your health will remain stable, that your home won't need major repairs, that your family members won't face crises where your help could make all the difference, that no opportunities will arise that require available capital. That's not a conservative bet. That's an incredibly risky assumption about how life actually works in your 60s, 70s, and 80s. The transformation in your financial position happens when you stop thinking in terms of elimination and start thinking in terms of optimization. Instead of throwing everything you have at debt elimination like you're trying to win some prize for getting to zero fastest, you make manageable monthly payments that your guaranteed income easily covers, and you maximize your liquid savings and accessible investments. This approach maintains what sophisticated investors call optionality. You preserve your options, you keep doors open, you maintain the power to make choices based on what's actually happening rather than being locked into whatever consequences flow from decisions you made years earlier when the situation was completely different. The beautiful part that people miss is this: you can always decide to pay off debt later if circumstances change. If you accumulate more resources than you need, if you simply change your mind about your strategy, that option never goes away as long as you have the debt. But once you've paid it off, once you've converted all that liquid capital into zero balances, you cannot reverse that decision without significant cost, time, and hassle. Put down options matter most if you're seeing why keeping your choices open might be more valuable than achieving zero balances. The revelation gets even more striking when you consider what actually constitutes strength versus weakness in retirement. Let's paint a clear picture here. Imagine you have $50,000 sitting in accessible savings and you owe $20,000 on loans at low promotional rates, maybe 3 or 4%. Most people, following conventional wisdom, would say you're in debt and need to fix that immediately. But that's not what's actually happening. You're not in a debt crisis. You're in a position of strength. You have options, you have flexibility, you have the ability to handle whatever emergencies come your way. You maintain control over your financial destiny. But here's the transformation that happens the moment you convert that. Accessible cash into eliminated debt. Your position shifts from strength to vulnerability in ways that aren't immediately obvious until disaster strikes. You go from having resources and manageable obligations to having zero resources and zero obligations. On paper, the second scenario looks cleaner. In reality, it's exponentially more dangerous because you've traded your capacity to respond for the satisfaction of seeing zeros on a statement. The impact of this decision extends into every corner of your retirement experience. When you have accessible cash, you can help your grandchildren with their education without hesitation. You can take that trip while you're still healthy enough to enjoy it. You can handle a major home repair without losing sleep. You can weather a market downturn without panic selling investments at the worst possible time. You maintain your autonomy, your dignity, your power to live on your own terms rather than being at the mercy of circumstances you can no longer control. Behind the scenes of every comfortable retirement is someone who understood that resilience beats perfection. They didn't chase the symbolic victory of being completely debt-free. They built actual resilience by maintaining strong cash reserves while managing their obligations strategically. And this resilience, this capacity to absorb shocks and continue functioning normally, matters infinitely more than any balance sheet showing zero liabilities. What's happening in the background that most people never calculate until it's too late is this: the money you use to pay off loans didn't disappear when it was debt. It was always there as a manageable monthly obligation covered by your guaranteed income. What did disappear when you paid it off was your emergency fund, your opportunity fund, your life happens fund. You traded something manageable and predictable for something irreplaceable and critically important. There's also a dimension to this strategy that exists in the intersection between debt management and tax planning that changes the entire equation. Certain types of debt interest actually reduces your taxable income. For retirees who find themselves in higher tax brackets than they anticipated, maybe because of required minimum distributions or pension income, this creates benefits worth thousands of dollars annually. When you carry strategic debt with deductible interest, every dollar you pay in interest lowers your taxable income. But the moment you eliminate that debt completely, you simultaneously eliminate that tax benefit. You've just voluntarily increased the amount you're sending to the government. Write in the comments, resilience over perfection, if this perspective is reshaping how you think about financial security after 60. The journey toward understanding this fully requires you to think about accessibility in ways that might feel uncomfortable at first. When you're retired, you're not the same person to financial institutions that you were when you were working. Banks and lenders fundamentally change how they view you the moment your income shifts from earned wages to fixed retirement payments. Your Social Security check arrives predictably, sure, but it doesn't grow. Your pension is stable, but it's capped. From a lender's perspective, you've lost your earning potential, and that makes you high risk in their eyes. Here's what this means in practical terms. If you drain your accounts today to achieve that debt-free status, and then 2 years from now you face an emergency that requires you to borrow money, you might not qualify. The door to credit that was wide open during your working years narrows considerably, and sometimes it closes completely. You'd have to reapply, probably at worse terms if you get approved at all, and you'd be doing so from a weaker negotiating position. The accessibility you had before retirement, that ability to get approved for credit when you needed it, that privilege slowly disappears, whether you realize it's happening or not. This is why maintaining strategic debt while preserving your cash reserves isn't just about the mathematics of interest rates and returns. It's about maintaining your position in the financial system, keeping your options open, ensuring that you're never forced to make decisions from a place of desperation because you voluntarily gave away your leverage. Now, there's something else happening in our current economic environment that completely changes the calculation, and most people are missing this opportunity entirely. We're experiencing a period where inflation is elevated, running at 4, 5, sometimes 6% annually. For most people, inflation feels like this scary force that's eating away at their purchasing power, destroying their retirement security. And yes, inflation does erode the value of cash sitting idle. But here's the hidden truth that transforms how you should think about debt. In this environment, inflation also erodes the real cost of your obligations. When you're carrying debt at interest rates lower than inflation, and right now, with promotional rates and balance transfers, you absolutely can find loan products at 2, 3, or 4%. Something remarkable happens. The debt you took on last year was borrowed in more valuable dollars. The payments you're making this year are being made with cheaper, inflated dollars. You're paying back less in real purchasing power terms than what you originally borrowed. Inflation is working for you, silently reducing your debt burden while you focus on other things. The transformation in thinking happens when you stop viewing inflation as purely negative and start recognizing it as a force that can actually work to your advantage if you position yourself correctly. The wealthy understand this instinctively. They're comfortable carrying manageable debt in inflationary periods because they know the math is working in their favor. They're not making emotional decisions based on cultural shame about owing money. They're making calculated decisions based on how economic forces are actually affecting their wealth in real terms. Comment inflation insight if you're starting to see how the current economic environment might actually make strategic debt more beneficial than eliminating it. Behind the scenes of this inflationary environment is an opportunity that most people are completely missing because they're too focused on the emotional discomfort of carrying debt. Let's break down what's actually happening with your money and your obligations right now. When you have dollars sitting in your bank account during a period of sustained inflation, those dollars are losing purchasing power every single day. What cost you $100 last year might cost you $105 or $106 this year. That's the erosion everyone talks about and fears. But here's what changes the entire equation. If you're carrying debt at promotional rates, and these offers are everywhere right now, if you have decent credit at 0, 2, or 3%, then inflation is eroding that debt faster than interest is growing it. You borrowed $10,000 last year in more valuable currency. You're making payments this year in cheaper currency. The real burden of that debt, measured in what those dollars can actually buy, is shrinking automatically without you doing anything. Time and economic forces are working in your favor, reducing your obligations in real terms while you maintain your cash reserves and flexibility. The transformation in mindset happens when you stop fighting this current and start using it. When you take a large chunk of your savings and aggressively throw it at paying off loans in this environment, you're essentially swimming upstream. You're volunteering to give up purchasing power today. Valuable dollars that could be working for you or protecting you to eliminate debt that was going to become cheaper anyway. It's like working twice as hard to achieve something that was already happening on its own, except now you've left yourself exposed and vulnerable in the process. This is where understanding the journey our economy has taken becomes critically important. Your parents lived through a completely different financial reality. They might have faced 12 or 15% interest rates on their debts while inflation was running lower. In that world, the math was crystal clear. Every dollar you could throw at high-interest debt was saving you significant money. Aggressively paying off everything made perfect economic sense. But we're not in that world anymore, and this is where so many people make catastrophic mistakes. They keep following rules designed for an economy that disappeared decades ago. The interest rate environment has inverted. The inflation dynamics have shifted. The entire economic landscape looks nothing like what your parents navigated, yet somehow the advice remains frozen in time. It's as if we're still being handed the same playbook from 1985, being told to execute the same strategies, without anyone stopping to ask whether those strategies still make sense, given how fundamentally everything has changed. Following old rules in a new game doesn't make you disciplined or responsible. It makes you vulnerable to risks you don't even realize you're taking. The revelation that needs to happen is recognizing that financial wisdom isn't about blindly following principles that someone taught you 40 years ago. It's about understanding the current environment, adapting your strategies to the reality you're actually living in, and making decisions based on how money and economics are functioning right now, not how they functioned in some idealized past that no longer exists. Put down new game, new rules if you're understanding why the strategies that worked for previous generations might actually harm yours. The impact of your financial decisions after 60 carries a weight that's fundamentally different from decisions you made earlier in life. And this is something most people don't fully grasp until they're living with the consequences. When you're 35 years old and you make a mistake with money, maybe you invest in something that doesn't work out, maybe you have to drain your savings for some unexpected crisis. What happens? You recover. The solution is straightforward and within your control. You work a few extra years, you take on overtime, you pick up side projects, you rebuild those accounts through effort and time. The wound heals because you have earning potential and decades ahead of you. That capacity to recover doesn't just diminish after 60, it disappears almost completely. Your primary earning years are behind you. Working more hours isn't an option when you're not working at all. Taking on additional income streams becomes exponentially harder. When employers see your age and make assumptions about your capabilities or how long you'll stick around, the safety net that existed throughout your entire adult life simply vanishes right when you need it most. When you lose liquidity at this stage of life, you haven't just made a temporary setback, you've permanently altered your financial position in ways that cannot be undone through effort or willpower. This is why the decision to drain your accounts and eliminate loan balances carries such enormous risk. It's not reversible. You can't change your mind 3 months later when reality sets in. You can't call your bank and explain that you need that $50,000 back because you made a mistake, or because circumstances changed, or because an emergency arose that you didn't anticipate. That money is gone, converted into something that looks good on paper, zero balances on loan statements, but does absolutely nothing for you when you're facing a medical crisis or a major home repair or a family member who desperately needs your help. The journey through retirement isn't a straight line where everything goes according to plan. It's messy, unpredictable, full of surprises, both wonderful and devastating. And navigating that reality successfully requires maintaining your autonomy, your power to make choices on your own terms, rather than being forced into decisions by circumstances you can no longer control. When you have accessible cash, you maintain that autonomy. You can say yes to opportunities. You can help the people you love without having to ask permission from anyone or explain yourself to institutions that don't care about your situation. You can handle emergencies with dignity rather than desperation. But the moment you eliminate your liquidity-chasing symbolic debt-free status, you've traded that autonomy for dependence. Now you're dependent on credit card companies approving you if you need emergency funds. You're dependent on family members if a crisis strikes. You're dependent on selling assets at whatever price the market offers, which might be terrible timing. You've given away your power and independence for a feeling that evaporates the instant real life demands action and resources. Behind every regret about money and retirement is someone who prioritized the wrong things. Not the people who spent their resources creating experiences and maintaining flexibility. They rarely have regrets. The regrets come from people who hoarded and constrained and sacrificed their autonomy for principles that didn't actually serve them when it mattered most. Right autonomy matters most if you're recognizing why preserving your financial independence might be more important than eliminating debt. There's something almost absurd about the financial advice industry that nobody wants to acknowledge openly, and once you see this contradiction, you can't unsee it. Every single financial advisor, without exception, will tell you that maintaining an emergency fund is absolutely essential. 3 to 6 months of expenses sitting in liquid, easily accessible savings. This is presented as foundational wisdom, non-negotiable, the bedrock of any sound financial plan. Everyone agrees on this. It's probably the one thing you'll get unanimous consensus on if you ask 100 different financial professionals. Yet here's where the contradiction becomes impossible to ignore. Many of those exact same advisors will turn around in the next breath and encourage you to drain that emergency fund, plus all your other accessible savings, plus every liquid resource you have to achieve this symbolic debt-free status. They'll tell you that being completely free of debt is worth sacrificing the very liquidity they just finished telling you was absolutely critical to your security. The logic breaks down the moment you examine it honestly. If having accessible cash matters, and clearly it does since that's universal advice, then why would you voluntarily destroy that accessibility for the sake of zero balances? The journey toward real financial wisdom involves recognizing these contradictions and questioning whether the advice you're receiving actually makes sense when you look at the complete picture rather than isolated pieces. The answer usually reveals itself pretty quickly once you stop accepting conventional wisdom at face value and start thinking critically about what serves your actual security versus what serves outdated cultural narratives about debt and responsibility. Now here's a dimension to this entire strategy that exists in a space most people never even consider because it requires understanding both debt management and tax planning simultaneously. Certain types of debt interest, particularly mortgage interest and sometimes specific loan structures, actually reduces your taxable income. For retirees who find themselves in higher tax brackets than they anticipated, maybe because of required minimum distributions from retirement accounts or substantial pension income or investment gains, this creates tangible benefits worth thousands of dollars every single year. When you carry strategic debt with deductible interest, every dollar you pay in interest lowers your taxable income. That means you're paying less to the government. But the moment you eliminate that debt completely in your rush to achieve debt-free status, you simultaneously eliminate that tax benefit. You've just voluntarily increased the amount you're sending to the IRS every year. And for what? For the psychological satisfaction of owing nothing, which does absolutely nothing to improve your actual financial position and might actively harm it. The transformation in understanding happens when you start doing the actual mathematics instead of following emotional impulses or cultural programming. When you factor in tax advantages on one side and inflation effects on the other, something genuinely remarkable emerges. The true cost of carrying certain strategic debt can actually be negative. You read that correctly. Negative cost. If your effective interest rate after tax deductions is 2% and inflation is running at 4 or 5%, you're being paid in real purchasing power terms to maintain your liquidity and flexibility. The debt is costing you less than zero when you account for all the factors working in your favor. Comment, "I see the math now," if you're understanding how tax benefits and inflation can make strategic debt actually profitable in real terms. Behind the scenes of wealth preservation is this understanding that money has multiple dimensions working simultaneously, and when you grasp how these dimensions interact, you unlock strategies that seem counterintuitive at first, but make perfect mathematical sense once you examine them honestly. Let's paint a concrete picture of what this looks like in practice. Imagine you have $50,000 sitting in your savings right now, and you're carrying loan balances at a 4% annual rate. Conventional wisdom is screaming at you to throw that entire $50,000 at those loans immediately, to eliminate that debt and walk away clean. But what if you kept that $50,000 invested instead? What if you positioned it in a diversified portfolio of stable, dividend-paying stocks and index funds that historically return 7 or 8% annually? You're creating what sophisticated investors call a positive spread. You're paying 4% on one side while earning 7 or 8 on the other. That 3 or 4% difference isn't just theoretical. It represents real wealth accumulation happening year after year, compounding over time, building resources that enhance your security rather than locking capital away into eliminated debt that's gone forever. The journey toward this kind of strategic thinking requires letting go of emotion and embracing mathematics. Investment returns aren't guaranteed, that's absolutely true. Markets fluctuate. But here's the revelation that reframes everything. Nothing is guaranteed. Your health isn't guaranteed. Living another 20 years isn't guaranteed. The economy staying stable isn't guaranteed. We're all navigating uncertainty constantly, every single day. The question isn't whether to take risks, because you're taking them regardless of what you do. The question is, which risks make mathematical sense, given your circumstances, and which risks you're taking without even realizing it? There's something most people need to hear, but financial advisors whisper about rather than stating plainly. Your loan balance is not your biggest financial predator in retirement. Not even close. The real monster lurking in your future, the one that actually destroys retirement security for thousands of people every single year, is running out of money while you're still alive, outliving your resources, reaching 85 years old and staring at depleted accounts with years of life still ahead of you and absolutely no way to generate new income. This is the genuine risk you should fear, not whether you have a few thousand in manageable loan balances. The transformation in your priorities happens when you ask yourself the right question. If you drain your liquid savings today to pay off loans, and then 18 months from now, you or your spouse needs extended care or faces a serious medical crisis, where does that money come from? You can't pay a nursing home with the psychological satisfaction of having zero balances on your loan statements. You can't cover prescription costs or home modifications or medical equipment with the feeling of being debt-free. Healthcare providers, family emergencies, unexpected crises, they all want actual money, accessible cash, resources you can deploy immediately. This is why maintaining what sophisticated investors call optionality matters more than achieving symbolic victories. You preserve your options, you keep doors open, you maintain the power to make choices based on what's actually happening in your life, rather than being locked into whatever consequences flow from decisions you made years earlier when the situation was completely different. Put down options as security if you're understanding why flexibility might be the most valuable asset you can maintain in retirement. The hidden truth about retirement that nobody wants to confront directly is that healthcare expenses represent a financial threat exponentially more dangerous than any loan balance you're carrying. Medicare covers a lot, and we should be grateful for that. But the gaps in coverage can be absolutely devastating when you're dealing with serious illness, extended hospital stays, specialized treatments, or the elephant in the room that everyone avoids discussing: long-term care. Nursing facilities easily cost $8,000 to $10,000 per month. In-home care with round-the-clock assistance can run even higher. A serious illness requiring specialized treatment and extended hospitalization can generate bills in the hundreds of thousands, even with Medicare coverage. These aren't scare tactics designed to frighten you. These are the actual numbers that real retirees face when health issues inevitably arise. And here's the revelation that should completely reshape your priorities. Most people will need some form of extended care before they die. The statistics are stark and unavoidable. The chances that you'll need either facility care or significant in-home assistance at some point are much higher than the chances you'll sail through your 80s and 90s without any of these expenses. This is the genuine financial threat you should be preparing for, not whether you have some manageable loan balances that your guaranteed income easily covers. The journey toward genuine financial wisdom after 60 involves this uncomfortable recognition that preserving accessible capital for healthcare contingencies matters exponentially more than achieving some symbolic debt-free status that leaves you cash poor when you need resources most. Behind every comfortable retirement is someone who maintained adequate liquidity for the healthcare expenses they knew were coming eventually. And behind every retirement disaster is someone who optimized for the wrong thing, who eliminated manageable debt while leaving themselves vulnerable to catastrophic costs that Medicare doesn't cover. Now, let me ask you something that cuts to the heart of this entire conversation. What was the point of all those years of hard work? Why did you sacrifice weekends, delay gratification, save diligently, and build your nest egg in the first place? It wasn't so you could spend your 60s and 70s obsessing over loan balances and denying yourself experiences just to see zeros on statements. You didn't work 40 years to live in austere deprivation during the years when you finally have the time to actually enjoy what you've built. The transformation in perspective happens when you realize you've earned the right to actually live, not just exist in some holding pattern waiting for permission to use your own money. Here's something nobody wants to acknowledge openly because it forces you to confront mortality. Experiences have expiration dates. Your health and mobility are declining assets, whether you want to face that reality or not. There are 70-year-olds hiking mountains and 70-year-olds who can barely walk to the mailbox. Time isn't the only factor, but it's a factor you absolutely cannot negotiate with. Delaying life to achieve some arbitrary financial milestone means you might miss the window entirely. You might reach that goal of zero balances only to find you no longer have the health or energy or cognitive sharpness to do the things you postponed. That European trip you've been planning, your knees, might not cooperate in 5 years. That time with your grandchildren creating memories, they'll be teenagers absorbed in their own worlds before you know it. The window for experiences closes gradually and then suddenly, and you don't always get advance warning. Right, living matters more if you're questioning whether chasing zero balances is worth sacrificing the experiences and security that money was supposed to provide. Before you make any decisions about your loans or your savings, sit quietly for a moment and ask yourself this question with complete honesty. If I drain my accounts right now to pay off this debt, will I regret not having this money available 5 years from now? Really think about it. Imagine yourself at 70 or 75. Imagine medical expenses are rising. Imagine wanting to help family members who desperately need support. Imagine opportunities or experiences you might want to pursue. Imagine markets crashing and needing liquidity to avoid selling at the worst possible time. If your answer is maybe, or probably, or even I'm not sure, then that uncertainty is telling you something critically important about your actual risk tolerance and your genuine need for flexibility. Long-term security matters infinitely more than short-term satisfaction from seeing zero balances on statements. The mindset shift required here is thinking in decades rather than years, thinking about resilience rather than perfection, thinking about what actually protects you versus what merely looks good on paper. If you've made it this far, you're clearly someone who thinks deeply about these decisions, rather than just accepting what everyone else is doing. That matters more than you might realize. I create content like this because I believe people deserve perspectives that challenge conventional wisdom, especially when that wisdom was designed for an economic reality that no longer exists. If this shifted your thinking even slightly, if it gave you permission to question what you've been told, or if it helped you see your financial situation through a clearer lens, I'd be grateful if you subscribe to the channel. I dive deep into retirement strategies and financial decision-making that actually acknowledges how the real world works after 60, not how outdated textbooks say it should work. Leave a comment saying, "This changed my perspective, so I know you stuck with me through this entire journey." It genuinely helps me understand what resonates with you and what topics deserve deeper exploration. And if you found value in this conversation, hit that like button. It tells me we're connecting on something important here. There's a video right here that takes this conversation even further, exploring specific strategies for building that cash cushion we talked about while managing obligations intelligently. Click and continue with me over there. I think you'll find it connects perfectly with everything we've covered today. Thanks for being here, for thinking critically, and for being willing to challenge the old playbook.